Japanese bond yields are rising, and for investors in the United States, that is not a distant problem. It is one worth understanding now. For years, interest rates in Japan sat near zero, sometimes even below it. Meanwhile, rates in the United States and Europe were far higher. That gap created an opportunity. Japanese investors and institutions borrowed money cheaply at home and put it to work in higher-yielding assets abroad: US Treasuries, American stocks, and other foreign holdings. This strategy became known as the yen carry trade, and it pumped enormous sums of Japanese money into global markets. Now that math is changing. The Bank of Japan has been gradually stepping back from its ultra-loose monetary policy, and Japanese government bond yields have been climbing. When yields rise at home, borrowing in Japan gets more expensive. That makes the carry trade less attractive. And when investors unwind that trade, they sell foreign assets and bring the money back to Japan. The risk is what happens if that unwind picks up speed. Selling pressure hits US Treasuries. Selling pressure hits US equities, both at the same time. That is the double hit markets would rather avoid. To understand the scale here, Japan is one of the largest holders of US government debt in the world. Any meaningful shift in how Japanese institutions allocate their money has an outsized effect on Treasury yields and on the dollar. This is not a small player making a marginal adjustment. It is a major force in global capital flows, reconsidering the terms of the trade. For US stock investors, the concern runs in two directions. There is the direct pressure from potential foreign selling, and there is the indirect pressure from what rising Treasury yields do to equities more broadly. When bond yields go up, stocks become less attractive by comparison. Bonds start offering real competition for investor money. Higher yields also raise borrowing costs for companies, which can squeeze earnings over time. The Bank of Japan has been careful to signal a slow, deliberate pace of change. This is not a sudden reversal. The carry trade does not unwind overnight. But the direction in Tokyo is clearly toward tighter conditions, and global markets are still in the process of adjusting to that new reality. The practical takeaway: treat Japanese government bond yields and the yen exchange rate as leading indicators worth monitoring regularly. When Japanese yields move, capital flows tend to follow, and those flows run directly through US Treasuries and equity markets. In a connected global financial system, Tokyo sets signals that Wall Street cannot afford to ignore. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.